This is the Insight is Capital podcast.
The views and opinions expressed in this podcast are those of the individual podcasters and do not necessarily reflect the official policy or position of advisoranalyst.com. This podcast is meant to be for informational purposes only. Nothing discussed in this podcast is intended to be considered as advice.
Hello and welcome to the Insight is Capital podcast. My name is Pierre Daly, managing editor of advisoranalyst.com. Our guest is Brooke Thackray. Brooke has over 20 years of experience in the investment industry. He's research analyst for Horizons ETFs and advises the Horizons Seasonal Rotation ETF, ticker symbol HAC. His seasonal investing strategies are regularly featured in newspapers and magazines, and he's also a frequent guest on BNN Bloomberg. He's also the author of 9 investment books and investing guides. Brooke, thank you very much for joining us and welcome to the show.
Well, thank you for having me on the show.
So, Brooke, you've been in the industry for well over 20 years. Where did you get your start and when did you decide to eventually do a deep dive into seasonal investing?
Actually, I started in the industry on the retail side, the sell side, back in the mid-1990s with a firm called TD Evergreen. And, at the time, I really got interested in, the cycles and trends of the market. People were trying to look at fundamentals, and fundamentals weren't working at that time. And they said, what else is out there? And so there's this, people were really stumbling around. But what really fascinated me was seasonal trends, basically. I start to take a look and say, hey, the stock market tends to go up in this period of the year more often than another period of the year, or certain sectors of the market tend to go up more often at certain times of the year. And I started, dive more into that over time. And so in 1999, I actually wrote my first book with Bruce Lindsay. It was called Time In, Time Out, Outsmart the Market Using Calendar Investment Strategies. So that was way back when, and that was really focused on the 6-month cycle. But at the time, it was probably the most seminal work on the 6-month cycle. Since then, we've had other people come along and do some really deep dives into that whole seasonality with Sell and May as well. And 2 professors have really taken this upon themselves from New Zealand, Jacobson and Zhang, and looked at it internationally and across countries and across big swaths of time, et cetera. But at the time, the book we did was actually very, very detailed on that. And that's something that I really followed up on. And over time, I found that more and more people have caught on to the seasonal trends, basically, and said, yeah, I understand that. There are some seasonal trends. This does make sense to me. And it wasn't, back in the 1990s, that wasn't something that a lot of people looked at.
We've been sharing your monthly newsletters with advisors for close to a decade now. Seasonal investing really provides practical information for investors to use in terms of making those types of tactical decisions. So how does it work? I imagine there's a mountain of data that you use in order to come to conclusions about different periods of the year, different months of the year when certain things are in and other things are out. And then there's anomalies, exogenous events like the one we're in right now. Also, how well does it work? Given the run-up that we've seen in equities, it might bolster the sell in May argument, given where markets have come to. But that's my question for you is, how does it work? And then let's continue on from there.
Yeah, so let's start with, how does it work? What is seasonality? Like, what are seasonal trends in seasonal investing? There's 2 aspects to it. The first one is, and you referred to it, Pierre, in saying that, the 6-month sell in May phenomenon, which basically says that 6 months of the year, the stock market tends to be weaker than the other 6 months of the year. And it's often referred to as a sell in May period. And that's actually a really misunderstood phenomenon, by the way, because a lot of people look at it and go, oh, if the stock market's up from May to October, look, it didn't work, But the way to look at this is that from my dates that I've used since the 1990s has been October 28th until May 5th. In that period, the stock market tends to do better in that 6 months. In the other 6 months, it tends to be not as strong. On average, since 1950, it's actually been negative. But even in bull markets, you find that 6-month period tends not to be as strong. And so there's that 6-month seasonality for the overall stock market. It also deals with sectors of the market as well. So that there's certain sectors of the market that go up at certain times of the year because of some sort of causational factor. It might be for commodities, supply-demand imbalances that occur in the energy sector, or it could be earnings that come out at certain times of the year to help drive the stocks up at that time, or it could be conferences as well. But something happens every year that drives a causational factor where investors become more interested in that sector and tend to push up the stock
right.
in that sector. Right. Does it work all the time? No, it doesn't work all the time. Nothing works all the time. But what you're really doing is you're increasing the probability of success by saying, oh, this is when technology tends to go up. This is when I'm really going to focus on technology or increase my weight in technology or whatever, however you want to play with it. That's the beauty about seasonality, because anybody can use it with what they do. It doesn't mean if you use fundamentals, or technicals, it doesn't mean, oh, I can't use seasonal trends. It actually complements them. It's another screen to say, okay, this is the time to look in this particular sector for it. It doesn't provide the opportunity. So it actually works quite well with all different disciplines as well, or by itself. We actually use a combination of seasonality, fundamentals, and technicals as well. I'll get into that a little bit later on for sure. But so the pandemic is, as you said, a big, huge exogenous event that has come along, and this happens once in a while in the stock market, and that doesn't obey technicals. It doesn't obey fundamentals. Coronavirus doesn't obey anything like this, or seasonality as well. Now, we did see the stock market correct sharply in that strong seasonal period from October 20th to May 5th. We've also seen most of the rebound take place in that time. Does it mean it's all out of kilter? That's it. It's going to be out of kilter for a few years, and the stock market's going to continue to run in this week or 6 months. No, it doesn't. Sometimes it's the shock that happens because of something like this. But I can't tell you when it's going to get back on track, but it can get back on track at any time. And if you take a look at our advancement, we're 2/3 away from the bottom to the top again. So we've really bounced a lot. So maybe this is the point where it gets some traction to get back on track. And I can't tell you that for sure, but it has thrown off seasonality a bit. There's no question, but it can get right back on track from the 6-month period at this point, especially since we've seen that run up already. And as far as the sectors of the market go, we still expect the sectors to do well within their seasonal periods. It's a long-term discipline. What you're looking for is most of it to work, which will provide the alpha in order to perform well against the market. So I think seasonality is poised. It didn't really get off track too much because we saw a big V in the stronger seasonal period. And yes, the market can still be weak over the next 6 months from here, which is that seasonal component where the market tends to be weaker. And I think we're actually poised for the market to pull back a bit. But it doesn't matter what I think. It just tends to happen at this time of the year because investors, I can't tell you if it's tomorrow or the next day or the next month or the following month, but in this period, investors tend to try to cut down their risk. And, they tend to be, say, I don't want as much risk. And they may pull back a bit. And that's when you tend to find the bigger correction. So let me just give you a couple stats on that, just to show you. If you go back to 1950 to 2019, you say, okay, look, what's a big thing you never want to do? You never want to leave the market and then miss out on a big, huge run, 10% or greater. So if you take a look from 1950 to current and you say, okay, in the period from May 5th, May 6th to October 27th, that 6-month period, which is the sell and May period, the S&P 500 has only gone up 10% or greater 8 times. 8 times. That's it. And all of those 8 times were off of recessionary conditions.
Right.
But if you look at the other 6 months of the year, from October 20th to May 5th, the stock market's gone up 28 times, 10% or more. So what that's saying is you tend to get bigger returns in the favorable 6 months. You don't get the big, huge returns in the summer months. Now, there can be rallies, of course, but you tend to get stronger times in that period when we're coming out of a recession. We may be heading into one.
Yeah,
we're not coming off of one. Although today's world with the big V and how fast it's happened, who knows? But we may be heading into a recession. So we're not primed for that 10% or greater, and the odds aren't as strong anyhow. The market just tends to be weaker at this time of the year.
I think what you might have been trying to say earlier, at least when you were beginning, is that sell in May tends to be viewed as a black and white decision.
Yes.
As all or nothing. And that's not the case, right? It's not that markets are going to tank in the 6 months off period, May to October. It's that they won't do nearly as well. The odds are, or likelihood is, they won't do as well as they do in the on season.
That's correct. That's exactly what it comes down to. There may be some returns, but you're taking a lot of risk for those returns. And the way we tend to look at it is, it's much better to focus on the sectors of the market that tend to do well in this time, rather than saying, I just want to be in the market with 100% equity at this time, because you're taking a lot of risk for on seasonal probability, small returns. And if you take a look, let's just take a look at this last bull market we've gone through from 2009.
Yeah, I wanted to ask you a question about that, but go ahead.
Yeah, so from 2009 to 2020, basically. In that time period, you take a look at the 6 months. Now, this is one of the best bull markets we've had.
Right.
The favorable 6 months from October to May has had some very strong return. The other 6 months have had much weaker returns. In fact, in all cases, except for 3 cases, you've seen the favorable period from October to May outperform the other 6 months of the year. So you've gotten bigger returns and a higher frequency of being successful from October to May. And that's in the bull market when the market's been going up. And that's with the Fed juicing the market at the same time. So we've had some really unusual conditions. But in normal markets, you tend to find that's exactly the case. In fact, over the long term, from 1950, 62% of the time, the unfavorable market from May to October tends to be positive. But the gains are so small on average.
Right. How do you tactically use that? Since these seasonal decisions are tactical in nature, how do you take advantage of that information without shooting yourself in the foot? I mean, if your mentality is it's May, the last 6 months have been really good, and should I rebalance? Like, do you use May or the sell in May seasonality to rebalance out some of the gains that you've had in equities into bonds? Or, I mean, I'll let you explain it.
Sure. Well, there's 2 aspects to it, I think, really. And the first one is from the retail side, it's best to look at it as from October to May, you put your foot on the gas pedal, right? You say within your risk portfolio or parameters, you tend to move to the risk side, high risk side, within what you can take or set out to be as appropriate. But from May to October, you take your foot off the gas pedal and you reduce your risk. So that's really, that's the best way to think of it rather than.
Okay. So what would be some ways that you would take your foot off the gas?
By being in cyclical equities, as an example, and moving into sectors of the market that tend to do well in the summer months, whether it's gold, whether it's, healthcare, utilities, consumer staples. So there's a number of sectors you can move into that tend to do better in that period. So why not go into the sectors that do better at that time?
Right.
Rather than just, I'm just going to have the S&P 500 or the TSX composite or whatever it is, and that's what you can have. You want to say, I want to reduce my risk by taking my foot off the gas pedal and focus on the sectors that work at the same time. And yes, you're right. Government bonds tend to do better in the summer months as well. So you're diversifying across different asset classes. So you're making the portfolio to be, tends to be more balanced, tends to provide a better risk profile. So what you're really doing is you're increasing the profile of risk-adjusted returns, so that your risk-adjusted returns actually look really good because you're adding this diversification across assets, and you're focusing on what are typically defensive sectors as well.
So it makes sense to build a portfolio using perhaps a group of sector funds as opposed to just buying an index. It would make more sense to build a portfolio that's spread out across different sectors and different market caps and different segments.
Yeah, from a seasonal standpoint, that's exactly what you do. You say, here's the market. We can use ETFs, and ETFs are wonderful tools to use for something like this, because really sometimes you're in a position for 4 months instead of going out and buying a whole bunch of individual stocks. And it still works. In fact, I write a lot about it in individual stocks. It still works with individual stocks, but what you want to do, the ETF is great because it allows you to go into that space. From a seasonal perspective, that in 4 months' time or whatever it is, on average, that's a good time to get out of that sector. Now, the way we do that is we'll use technicals to make that decision. Because if you think about it, I'll come back to the question in a second, but there might be 10 sectors or 15 sectors that are seasonally valid sometimes. And you're not going to invest in all 15 sectors. Right. There's 10 sectors to market, but some subsectors. So you do some metrics, technical tools to help say, okay, these are the 5 or 6 that we should go into. And you'll use that to go in early, go in late, or not go in at all to the different sectors. But ETFs are a wonderful tool for that, because you have an exit date at some point, and give or take a bit. In our case, sometimes it's a month or a little bit longer. Well, we can say, okay, we can hold longer if there's strong momentum, and say, okay, we'll use tight stops and help with that management process. But it really has to be seasonal driven, But ETFs are this wonderful way to actually get into that space and reduce the headline risk because you're going to be there for 4 months or 3 months or 5 months, depending on what the investment trade is.
So typically, Brooke, what is seasonally strong in the October to May period?
So in that period, there's a number of sectors that you'll find technically strong at different times in that period. So you'd find technology does well, starting in October.
Why is that?
So the technology sector, if you take a look at technology, most money that's actually spent on technology is actually spent in Q4. It's not just the retail side. Apple used to come out with their conferences a certain time of year and that time of year, and they're all going to launch their products because the retail side, that's when people buy most of their technology. On top of that, companies as well. If you've got a budget and you've got some money left in that budget, it takes a long time to figure out the furniture and spend money on furniture. You'll be arguing forever, but technology, that goes really fast. So you find a lot of money gets spent on technology, and technology companies have their Q4 calendar quarter year. It tends to be very strong. And a lot of the products get announced that time. So investors want to be in there before that all happens. And that's why they'll get into the technology sector at that time as well. So there'll be some of the cyclical sectors, whether it's the industrials and materials that will do well, financials. So it's the more cyclical sectors that tend to do well in that period. Whereas the period we're in right now, from May 6th to October 27th, it tends to be the more defensive sectors that do well. And, there's going to be some iterations along the way where that's not going to hold true in the short term. And you look back in February, March, you saw consumer staples, healthcare, like, wow. But there was a reason for that. That was the coronavirus, put the focus on the healthcare. People wanted the dividends as well. Consumer staples, because those companies were benefiting from what was taking place. Investors still wanted to be invested and they were going to healthcare. So that was out of sync. And that happens. You can get out of sync like that. We've seen the defensive sectors underperform now, coming back into the start of the seasonal period, but now we're in the seasonal period where they tend to perform better. But in the short term, that may not be the case. But over the longer term, over the next few months, this tends to be a better time for those type of sectors. And they all have different start and end dates as well. But it tends to be the consumer staples, the healthcare. Biotech tends to do well in this time period. Short within this time period as well. At the same time, gold as well. Gold miners tends to do well. Not right now. We're not. So when I'm saying the 6-month period, that's from May to October. But gold tends to do well in July until late September, early October. So within that 6-month period, there'll be different periods where the different sectors will perform well.
One question I wanted to ask you about the bull market from March of 2009. Were there any ways in the bull market that seasonality was affected by easy money?
Sure. So I call the Fed my best friend because it juiced the markets. They're largely responsible for the strength of the bull market that's taken place since 2009 by the quantitative easing and their monetary policy. So my best friend because it juiced the markets. But also my worst enemy because they tended to do it in the summer months when the market tended to be weaker. So what you'd see the market would correct. And the Fed always says, we have two mandates, it's employment and price stability. But, Greenspan said a long time ago, the wealth effect, and basically saying that they want to keep a stable stock market because of its implications on the economy. And so when the stock market would tip over in the summer months, 2012, 2013, whatever, in this time period, the Federal Reserve would come along and go, okay, it's going down. We need to jump into the market and do something here. And they would come up with something, or they would announce something, or they'd meet Jackson Hole, Wyoming in late August and, announce that they might be doing something. And they would push the market up in a time period when it typically wouldn't be strong.
So that would interrupt your thesis.
Yes and no. So it did. There's no question. I think over the last 10 years, despite the October-May time period strongly outperforming the other 6 months of the year, if the Fed didn't intervene like it did in almost all cases in that 6-month period from May to October, we would have seen weaker markets and we would have seen bigger downturns in what I call the unfavorable 6-month period for the stock market. Now, even when they did this, overall, it's still stronger from October to May.
Right.
If they did this in a time period, I just think the performance would have been the dispersion between the two would have been much bigger than what it is now. So seasonality's worked, but it would have worked really well if the Fed wasn't doing what it did in the weaker times when the market tends to be weak, when it was weak.
How much of seasonality is fundamental to human nature versus a technical event? How much of it has to do with us, our behavior as corporate citizens or our behavior as consumers?
The best way to think about seasonality is, and we call it seasonality, but it's almost a misnomer because it's really based upon behavior. And you hit the nail on the head because we're really taking advantage of people's behavior. And that's the best way to think about seasonality. And as an example, let's just go through some examples that would show this. If you said to somebody, when's the best time to buy natural gas? Because seasonality works with commodities as well. They go, oh, when it gets cold. That's the best time to buy natural gas.
Yeah.
It's actually the best time to buy natural gas is before it gets cold. So when everybody else buys natural gas, when it's starting to get cold, then the natural gas is needed for heating, and when they're buying it, you want to be able to sell. So the objective really is to get in before everybody else gets in.
Right.
When everybody else gets in, you get out. That's really what it comes down to. The retail, I know retail suffered greatly, in a long-term, structural decline over the last few years because of online shopping. But if you take a look at seasonality on this, the best time for retail isn't to buy when Black Friday is happening. That's not when the best time is to buy it. It's before.
Right.
So you go in late October, and then you say, okay, now everybody's getting into the sector because the holiday shopping season is starting. I'm going to get out. Because retail tends to be weak in November and December, the actual stocks. Another example would be UPS. UPS has underperformed the S&P 500 since it was launched in 2000. But UPS does particularly well. In fact, it's outperformed the S&P 500 in that time period from October 10th until December the 13th by almost 90% of the time. So despite underperforming, overall on average, you would be better off than the S&P 500. In that window, almost 90% of the time, you're going to beat the S&P 500, and substantially. Not every single year, but very frequently. And the average is actually very strong. And there's a reason for that. It's behavioral. Yeah. If you take a look, people will go and, the average investor on the retail side, well, why would I buy UPS in the middle of the summer? What's happening? Nothing's happening. They say, oh, Christmas is coming up. And that's when I want to get in. I want to be there because they look at making a decision to get into UPS. Now, UPS can do well in the summertime, and it has done well at different times. But the best time on average is, from October into mid-December. And it's because the average retail investor goes, oh, I want to get into retail when they're really shipping stuff. And no, that's the best time is before that takes place. In fact, you sell right before the busiest time of the year. The busiest time for UPS is actually, mid-December until late December. You want to be out. So it doesn't matter what the results are. You're really taking advantage of people's behavior. And that's true for the energy sector. We can go through a whole bunch of different examples, but they're all the same. You want to get in before it becomes of an interest to everybody. And when everybody else gets really interested and they start pushing the price up, then you get out. That's what it comes down to.
Well, I'm really, one thing I'm looking forward to doing with you, Brooke, is doing a monthly or bi-monthly, however it works, depending on what the seasonal periods are throughout the year, as opposed to the 2 6-month blocks. Some of the elements that you've just been talking about are really interesting in terms of getting ahead of retail or getting ahead of natural gas or getting ahead of UPS or companies in that domain in terms of when their seasonally strong periods are and when do you actually want to be a seasonal investor in those trends. I think right now one of the things that's really bizarre to most people, even those who have been in the markets for a very long time, is many folks, maybe non-investors, investors alike, are dumbstruck. The stock market is going back to its previous highs while the economy is going into the worst position perhaps in all of history. And one comment I wanted to make was that seasonality the study of seasonal trends makes more sense of what's happening in markets than looking at here's what's happening in the economy. Human behavior as a fundamental part of seasonal investing strategy makes more sense of the market than looking at the economy and the market and trying to make sense of that. How has this pandemic affected seasonality or the seasonal investing strategy, given that the US, for example, has close to 40 million unemployed?
Yeah, so I mean, sure, there's a huge disconnect right now with the economy and the stock market taking place, at least in the classical terms of what we think. And you're right. I think, investors are looking out past the normal time period. We typically say the stock market forecasts out 6 months or 9 months. But we already know in 6 to 9 months, the economy won't be as strong as it was based upon the trends that are taking place. And investors are looking out past that into 2021, 2022. And I call this, some sort of duration expectation risk, because they're really pushing out their expectations far out in the curve on something that we just don't know. There's a lot of risk.
Yeah, you just wrote about that in your latest newsletter.
Yeah, absolutely.
Yeah.
And what that does is it just increases the tail risk of something happening. But from a seasonal standpoint, we don't get too caught up in that breakdown between the economy and the stock market. It doesn't make sense to me what's going on. If I take a look at what's happening with, as you say, there's companies you go, I don't understand it. They're doing so well. And there's a lot of expectation where money's flooding into the market because everybody's trying to front run the Fed. But what does that mean from a seasonal standpoint? So how do we reconcile that with seasonality? That's really the big question for me. And that is, the market tends to be more fragile over the next 6 months into October. So, we may have a case of FOMO right now, or whatever you want to call it, fear of missing out, or, we can look at a whole bunch of different things that are taking place where companies are going up and investors are pouring into the market and very positive expectations. But the market tends to have bigger drops at this time of the year. It tends to be more volatile, particularly in August and September. So August, September, October tend to be the three most, you see a big ramp in volatility that takes place. So when all this is going on right now, it's, from a seasonal perspective, you'd say, okay, well, you can't really change the mandate of what you're doing. Say, oh, something's different happening. Chase the market, for instance, because it can reverse on you. And nobody should, whatever investment, somebody's looking to invest in, create a strategy, you create a discipline. You can't start breaking that discipline down and say, oh, I'm going to do something on that. And it's the same with seasonal. And I think that's absolutely appropriate for now, because although we're seeing the market actually perform well, and this happens, it doesn't mean that May 6th, the market goes down until October 27th. That's not what that week seasonal period means at all. What it means is...
Exactly. It's not black and white. It's not about having 100% risk and versus no risk.
Well, it's also too just that the stock market doesn't go down every day, slowly all that time. There's rallies along the way. There's, euphoria that takes place. There's corrections that take place. So you have to not worry too much about what's taking place and say, okay, seasonally, I know this is when the stock market tends to suffer a bit. It can have bigger downturns. This is when you tend to get the bigger downturns. And it tends to be more fragile as well. So a catalyst can happen, and we saw that happen very quickly in February. Something like that can happen as well. So although I think you're right, in the short term, the economy, it doesn't matter with what's happening in the stock market. But I don't think you have to try and reconcile them within a mandate. I think you have to sort of say, this is what the mandate is. Here's how it works. And you have to trust that mandate.
Yeah. It's still very much a matter of sticking to your rules. Looking at the chart for HAC, it really demonstrates the discipline very well, because it's been a very steadily rising fund since inception. I won't get into the performance of it. And here and there, it gets interrupted by market disruptions. But it's a really nice looking chart. That's really the benefit of sticking to the rules and saying, okay, this is a time, no matter what's happening, no matter how good the market's running, this is the time to be paring back risk. And October is the time to be increasing it.
Absolutely. I mean, because we just don't know what's around the corner and something can change really fast. And the narrative can change really fast as well. And maybe in a couple of weeks' time after Memorial Day weekend, all of a sudden the coronavirus cases spike or something, and all the narrative changes. I can't tell you if that's going to happen.
Yeah, right.
I can't predict the future. I just have to say, here's the mandate, and this is the way the seasonality works. And there's just a lot more risks to be invested, even if the market's going through some sort of euphoria stage. And, personally, I have my own thoughts on what it is, but it doesn't matter. It's the seasonal trend that matters.
So if you had to pick, what is it that sticks out the most to you that confirms your belief in seasonality? If you look at seasonality and you ignore all of the distractions in the market, what is it about seasonality? What one or two things about seasonality is reassuring to you?
Well, if you take a look, seasonalities work quite well. And this is a bull market. Now, if you go back and take a look at markets like 1966 to 1982, for instance, take a look at the seasonality of the broad market in that time period, where the market moves sideways, seasonality does even better. So this is the toughest time for seasonality right now over the last 10 years, because we've been in a strong bull market. And as I said before, the Federal Reserve has been juicing up the markets in that 6-month period when it tends to be weak. I find it hard to stretch forward and say over the next 10 years, we're going to see the market, substantially above where we are now, making 10%, 15% gains per year. It doesn't matter if that's the case or not, but I just find it hard to find that that's the case. We're going to repeat the same level of performance we've seen over the last 10 years. I find that hard to believe that that's going to take place.
Right.
It could, and seasonality would work. But I think the market's primed for the seasonality to even work better. One of the things I've done too is I've gone back and I always take a look at the seasonal trends and say, which one worked this year? How well did it work? And, in this bull market, the success rate's actually been quite good. But I think it would be even better and with better returns in a more normal market where we tend to have more down years, more volatility as well. So, and not a strong bull market. So I think it's well poised for the future. So that's what I like about seasonality. That's my takeaway with, how it's done.
Yeah.
And also how it's really set up to do well in the future as well.
So, Brooke, given that we've been stuck at home for the last several months, is there anything you've been reading? Is there any books that you've been reading that you really enjoyed?
Well, typically what happens is I like to go away and I take about 10 books with me to read when I go away. I was supposed to go on March break with my wife. And I had all these books lined up and was so excited, and we had that travel advisory 2 days before we were supposed to leave. So obviously we couldn't leave. Actually, I'm writing my next book right now.
Oh, terrific.
So, yeah. So, and I'm trying to do some really cool, neat stuff for the next year as well. I've come up with a series of videos recently. So actually, this has been an extremely busy time for me. So I haven't had a lot of time to actually be delving into books. I've got, get a list and put them away. But right now, it's more about writing and producing for me than actually reading.
Well, Brooke, it's been a sincere pleasure to talk to you today and get your insight on the market.
Well, Pierre, it's been a pleasure doing the show with you, and I look forward to coming back on the show. But it's been a pleasure.